All right, so we're diving deep today
Deep.
into the world of indexed universal life insurance,
IULs.
IULs.
Yeah.
You know, I think a lot of folks out there, they hear about these things, they sound a little too good to be true.
Yeah. How can you get stock market gains, but without the risk?
And you sent over this document to me titled, How Can They Do That? Which is a question I think a lot of our listeners probably have.
Right. It's targeted towards financial professionals.
Yeah.
So
let's break it down together and kind of figure out what makes these IULs tick.
let's do it.
Okay, so the secret sauce here, the document, really zeroes in on this idea of using options.
Auctions. Yeah.
Now, I'm not a Wall Street wizard or anything, but options, as I understand it, they're kind of a way to play the market without actually, buying the whole enchilada.
That's a good way to think about it. Imagine you're feeling bullish on tech stocks,
Okay.
but maybe you don't want to sink all your money into, Apple or Google or whatever.
Right.
Options let you essentially bet on whether the price of something will go up or down.
So instead of owning the stock, I'm basically saying, I think it's going to go this way.
Yeah, exactly. And you can profit if you're right.
Okay, so there's got to be some different flavors of these options, right?
Yeah, so you've got your calls and your puts.
Calls, puts.
Calls are like you're calling that the price is going to go up.
Okay.
And puts are you're putting your money on it going down.
Got it.
Yeah.
So which one of those bad boys are we talking about when it comes to these IULs?
IULs are all about those call options.
Call options.
They're looking for that sweet, sweet upside potential.
Okay, so how does that actually work? I mean, I'm picturing my monthly premium payment, right? Where does that money go?
All right, so part of it goes towards the death benefit.
Right, the insurance part.
Exactly, the insurance part. Then there's some fees, got to keep the lights on.
Of course, the administrative costs.
But here's the kicker. A chunk of that premium gets used to buy call options
Okay.
on a specific market index.
So that's how they're trying to tap into the market growth. But hold on a second. What about the whole no risk thing?
Yes, the safety net.
The safety net.
That's where the bonds come in.
Bonds.
The majority of your premium, like 95% or so, goes into this nice and stable bond portfolio.
So even if the market takes a nosedive, I've got those bonds kind of holding things steady.
Exactly. Bonds are way more predictable than stocks.
Right.
So the insurance company can pretty much figure out when that 95% will grow back to 100%.
So it's like two separate engines running at the same time.
Yeah. It's kind of like having your cake and eating it too.
That's what they're trying to do.
Right.
Which is a bold claim.
It is. And this document makes sure to point out that the math behind all this is legit.
It's not just like some financial voodoo.
No, it's all based on sophisticated models and calculations.
Okay, so speaking of math, you mentioned something about leverage earlier. How does that play into all of this?
So leverage with call options means their value can skyrocket if the market goes up.
So like a multiplier effect.
Exactly. And that's how the insurance company can potentially pass on those big gains to you.
Okay. So I could theoretically get a much bigger return than just holding bonds.
Theoretically, yes. But remember, there's always a trade-off.
Right. Nothing's for free.
Your gains are tied to how well that specific market index performs.
If that index tanks...
You're not going to be seeing those big returns.
Right. So it's not exactly risk-free.
It's definitely not risk-free.
Okay. So big picture here. IULs are trying to walk this tightrope between the safety of bonds and the potential growth of the market.
Right. They're trying to offer the best of both worlds.
But they're making a big bet on the future, right? This whole thing hinges on the assumption that the market is going to keep going up over time.
Yeah, that's a key assumption. And it's important to remember that no one has a crystal ball.
So what happens if that assumption turns out to be wrong? What if we hit a prolonged downturn or just, things stay flat for a long time?
Well, in that scenario, those call options might not deliver the kind of returns that were projected.
And that could really throw a wrench in the whole system.
It could have a significant impact on the performance of the policy.
Wow. There's a lot more to consider here than meets the eye.
Definitely, IULs are a complex beast.
Well said. And for our listeners out there, if you're thinking about incorporating IULs into your financial plan, remember that understanding the mechanics is just the first step.
Right.
You got to consider your own individual circumstances, risk tolerance, and long-term goals.
Absolutely.
This deep dive is just a starting point for your own research and decision-making.
Couldn't have said it better myself.
All right, folks, that's going to do it for this deep dive. Thanks for joining us as we navigate the fascinating and sometimes confusing world of finance.
Always a pleasure.
Until next time, happy investing, and remember, knowledge is power.
Knowledge is power.
Stay informed and stay ahead of the game.
Stay ahead.
See you next time.
See you later.
Bye.
Bye.